Do you know why most traders lose money in the market? It's because they jump in without a solid trading plan. That's why today, we're going to show you a powerful day trading strategy, a smart money trading plan that guides you from start till entry, with mechanical rules to be followed. Whether you're struggling with entries or taking losses too often, this strategy will give you a clear edge over the market. So, before you take another trade, make sure you watch this till the end. This trading plan is a day trading strategy, which means traders open and close their positions within the same day and do not hold their trades for the next day. This strategy prevents overnight risks and focuses on capturing short-term price movements. The advantages of day trading compared to swing trading and scalping are summarized in the chart below. Day trading offers a balance between swing trading and scalping, making it a great choice for traders who want frequent trade opportunities without the extreme fluctuations of scalping on lower time frames or the overnight risks of swing trading. It also works well with smart money concepts, allowing traders to apply precision entries based on liquidity, order blocks, fair value gaps, and market structure concepts. Strategies effectively, you must first understand the latest evolution of smart money concepts. These principles form the backbone of this system, and your success depends on applying them correctly to the chart. Let's start with supply and demand. Supply and demand are zones on the chart where traders have entered the market, causing the price to move away sharply from that level. Normally, we mark the beginning of this sharp move as the demand and supply areas, and we expect the price to reject this zone when it revisits it, because of the behavior of market participants. However, there are several key factors to consider when identifying valid supply and demand areas for trading: inefficiency, break of structure, and the push distance. Each of these concepts serves as a critical clue to help confirm the strength and reliability of the zone. Inefficiency occurs when price leaves an area quickly, creating an imbalance between buying and selling orders. This imbalance is identifiable through fair value gaps left between consecutive candles. These gaps suggest that there is a lack of supply or demand at that level, making it a potential turning point. Break of structure, BOS, happens when the price moves past a key support or resistance level, indicating a shift in market sentiment and confirming the potential strength of the supply or demand zone. Every time price breaks a structure level, it signals a potential trend continuation. The push distance refers to how far price moves away from the zone before returning. A larger push distance often signals a more significant rejection, making the zone stronger. By considering all these factors together, you can more effectively identify high-probability supply and demand zones for your trades. Here is an example of a high-quality demand zone. If we draw the zigzag lines on the Euro-Dollar 1-hour chart, we will see highs and lows marked like this. The latest impulsive movement meets all the criteria for a high-quality zone. It has created a fair value gap, broken through the previous market structure, and pushed the price higher by a significant distance compared to previous moves. Once the price retraces back to this zone, there is a higher probability that it will reject this area and continue moving upwards. But what happens if the price breaks and closes below this high-quality demand zone? This would indicate that buyers have failed to hold the level and sellers have taken control. It signals that the uptrend is over and a potential reversal is underway. So, when price breaks through a high-quality level like this, we can confidently say that the market structure has shifted and the momentum is now favoring the sellers. This condition is known as a change of character, signaling a shift in market sentiment. The change of character is valid except in two common scenarios. Sometimes the market structure conditions make these changes invalid. Let's break this down step by step. Right here, we have a major swing low that triggered this breakout. A break below this level might seem like a valid change in character. However, if you look at the left-hand side, you'll notice something crucial. This level aligns with a significant area of liquidity. Here's the deal. Many traders previously opened long positions at this level, placing their stop losses just below it. What does this mean? A massive pool of liquidity is sitting beneath that level, waiting to be tapped. Now, smart money knows this. To hunt these stop losses, they often push the price lower, sweeping the liquidity before driving it back up in the same bullish direction. Here's the key takeaway. When a major swing low sits in a liquidity hotspot, breaking through it is often just a liquidity grab, not necessarily a signal of a market reversal. In this context, we can't classify this break as a valid change in character. If the price re-enters the range after the liquidity sweep, it creates an excellent opportunity for a long position. Why? Because the overall trend remains bullish, the sell-side liquidity has been engaged, and the next target is the buy-side liquidity. As smart money traders, our goal is to enter after the stop losses are taken out, when the real move begins. Now that's just one piece of the puzzle. Let's talk about another concept that can also invalidate a change of character: the mitigation of fair value gaps. As a smart money trader, identifying FVGs should be one of the first steps you take when analyzing a chart, because these zones often act as magnets for price.